Welcome to TheoTrade. This is Don Kaufman. Here we are. It's January 28th, 2017. I'm doing the weekend update. Let's get started with a quick review of some of the action that we saw, or lack thereof, in the markets this past week. And again, I like to be a bit forward-looking. So first and foremost, the biggest headline out there that you had to hear all week long in the markets, and it was, predominantly media-driven, was, of course, the Dow. So let's get it out of the way right now. Of course, the Dow hits the lovely number of 20,000. So I, of course, don't put a tremendous amount of weight into the Dow. At the same time, though, and this is much more of significance, the S&Ps, and you can see, of course, the S&Ps, which I have pulled up here in the chart, the SPX, that too hit record highs, of course, this week. So the Dow 20,000 is neither here nor there. The reason the Dow, of course, is really not on the forefront of what I discuss, the way that the Dow is weighted in today's market, I don't find a very efficient way to kind of, gauge the overall market. Nevertheless, the S&P 500 is a market capitalization weighted, meaning products like Apple, being the largest stock pretty much in the known universe, carries a lot more weight than something like Netflix, which effectively is, somewhere in the neighborhood between like a $50 and $60 billion company. Now, let's move a little bit forward here. So the SPX hitting all-time highs. Throughout the course of the week, I had to hear like, oh, it's explosive move to the upside. Was it really an explosive move to the upside? I mean, statistically speaking. So let's get a quick look back at the week. As many of you know, I am very much into not only statistics of the market. Again, I kind of grew up around quantitative traders. That means, they're not as so inclined to look at charts as they are, statistical measurement in the marketplace. And one of the things I look at extensively, of course, is what we term expected move. So right now we're looking forward to next week's expected move. And I say next week, all right, forward week, right here is the February 3rd, right? We're going to cross right into February here. And the entire coming week is expecting about a 23-point move. I'm just rounding this over here to 23-point move. But again, throughout the previous week, all I had to hear was, wow, the market made this most explosive move it's made, since back here in December. Nevertheless, was it really an explosive move? And the way that I measure that, and this is of critical importance to you, if you trade, if you're an investor, it doesn't necessarily matter whether you're long, whether you're short. Why is this of critical importance? Okay, what you're looking at over here is end of day data. I use this tool a lot to explain expected move and how important expected move is. So I'm in the analytics tab of Thinkorswim and I'm in Think Back. It's just end of day data. Okay. And what we're going to look at here happens to be the January 27th expiration. That was yesterday, right? January 27th. Okay. Today's the 28th. I'm recording this on a Saturday. It was Friday's expiration. And it was a full 5 days. So in Think Back, and I'm going to open this up, what I did is I backed up the date. Again, today is the 28th. I backed this up to the 22nd. Why? Because I wanted to see, again, a week ago, what was the market, all right, ultimately pricing risk to be? And it's a pretty simple answer. Well, a week ago, the market had about the same expected move that it has right now. $22, okay, and 22 cents was the expected move. Now, a week ago, the S&Ps were sitting at 22.71. Now, if you're like, okay, get somewhere with this. Oh, I'm going to get somewhere with this because I think, again, this is of absolute critical importance. So do some quick math over here. The S&P, all right, I'm going to pull up my trusted calculator. The S&Ps a week ago were at 22, again, 71.31. The market was expecting a $22.22 expected move. So let's add that to it because the market went up. Now this says it could go up or down. Now, obviously we know that the market went up this past week. So add 22 point, we'll say 23, we'll round, equals 22.9354. Now, I'll pause right there for just a second. This is what the market was anticipating. That was the edge of the range. And I've been continuously talking about these expected moves, how the market is currently more efficient than it ever has been before in the history of recorded markets. So the market was expecting, all right, that the outer bounds of where it could go to was basically what? 22, basically 94. Oh, how ironic. Right at the top of your screen over here. There it is. There's the SPX. That was the closing price, 22.9469. You do realize this stuff is happening week in and week out, that we're moving not only inside of expected moves, but we're actually moving to the edge of expectations. And, you realize like this isn't even really a rounding error. Like it's that crazy. When I say it's not even really a rounding error, this is a $2,300 product that literally moved within a few pennies of where it was supposed to go. So I looked at other major ETFs and I wanted to see, is it similar in other major ETFs? So here I went to the XLF. In the XLF, it's the financials. I look at the financials a lot because they've been a great kind of litmus test for the entire marketplace. So the financials a week ago were trading at 23.15. Their expected move is 45 cents. So if you added 45 cents to what, 23.15 comes out to 23.60. All right, it's 23.65 is where they ended up. And, I can go all day long with these expected moves. So why is this important? Okay, back to the SPX for just a moment. If you look at the SPX was expecting a 22-point move last week. And we got it pretty much to a T, right? Look at this week now. And close up this left side bar. Why am I now looking at this week? Okay, so now this week, with 6 days remaining, it's expecting basically a 23-point move. It's roughly the same as last week's expected move. The reason this is so important, okay, if you took a look at a calendar, there's all kinds of news coming out this week. What kind of news are we going to see this week? Well, let me get right to it. Number one, we do have a number of bond auctions. There's an ADP employment report, neither here nor there. Those bond auctions, though, can move markets. There's a petroleum status report, yada, yada, yada. There's an FOMC meeting right there, all right? There is zero risk being priced into the FOMC meeting. So all throughout the course of the week, when you're spending time listening to the media, well, Janet Yellen could say this, could be this in the notes. Zero risk. How do I know that there's zero risk priced into it? Because last week did not have an FOMC announcement, right? Look, there's the expected move last week. You're looking at it. It's 22.26. This week has an FOMC announcement, yet the expected move is $23. There's no risk being priced into that. Moreover, it gets even crazier, okay? So there's an FOMC meeting. There's also an employment report coming out this week. There's all kinds of numbers coming out this week. The market is no longer pricing in the FOMC as risk. The market is no longer pricing in an employment situation as risk. It is completely negating it. And, throughout the week, I was thinking about this as the market was hitting, its all-time highs of 20,000. I'm like, wow, man, things are really hitting a fever pitch out there. You think the market might get a little crazy, might get a little euphoric? Come on. Janet Yellen couldn't even throw a curveball in there. Speaking of Janet Yellen, okay, you have to find irony in the fact that the FOMC report happens to be on February 1st. And if you've never heard me say this before, you're going to hear it for the first time right now. It's Groundhog's Day. That is, Janet Yellen comes out, sees her own shadow, basically 6 more weeks of absolutely nothing. The irony of that entire thing is, well, February 2nd really is Groundhog's Day. You can't even make that stuff up. So the Yellenator missed the actual Groundhog's Day by 1 day with the FOMC announcement. I'm in no way, shape, or form comparing Janet Yellen to Punxsutawney Phil. However, okay, they basically do the exact same thing every 6 weeks when they have the FOMC announcement. That's kind of why we call it Groundhog's Day here at TheoTrade. Nevertheless, let's move onward and upward because this SPX stuff, it's important as, again, everything is going to be like media driven. You're like, oh, there's big expectations for the FOMC. No, they're not. Maybe they grow throughout the course of the week, but that's why you look at expected move. Okay, big stuff going on in the market. Obviously, S&P's cranking to new highs over here. The XLF didn't crack into highs, but again, it's right back up in the 23 half plus range to the upper end of this recent range over here. But what I noticed this week, and again, everybody's like infatuated with earnings announcements. Okay, it's Google. Yay. It backed off a little bit. We'll see if there's some follow through over here. There's a lot of big earnings that are going to be out this week. Okay. One of the ones, of course, that's going to come into perspective is going to be Apple, Facebook. Facebook is still, a little bit around the corner over here, but it's this week. Everybody is looking towards the Amazons and so forth. Oh, you got to wait a little bit for that. But you got Amazon, you got Apple, you got Facebook. Okay. And we already went through one of the largest earnings days. We basically on Thursday, we had Google, Microsoft, and Intel all ultimately releasing at the same time. But neither here nor there. What I'm looking for right now is larger term trends. And one of the ones that really stands out, it's not financials. Financials, again, caught a little bit of a bid. But as I said, the financials have been a great signature of what the entire marketplace is doing. Okay, where I'm actually looking right now, it's retail. What the heck is going on in retail? And specifically when it comes to retail, this is like what they kind of call consumer staples. All right. There's consumer discretionary, which those are discretionary items like, oh, I really needed that new purse. Okay. Or consumer staples, like something like Walmart. It's getting whacked back. For disclosure purposes, I am actually holding a very small, albeit short position inside of Walmart. Okay. I always disclose when I've got a position out there. I'm looking at the Walmart position and I'm actually considering maybe a little bit more follow through to the downside, but I'm actually considering covering this particular position. So Walmart, extremely soft. Target, getting crushed day in and day out. Okay. But one of the trades that I've been looking at happens to be inside of the XRT, as the XRT is getting smacked back hard. All right. Right now, if you take a look at the XRT, what is it? It's the Spiders S&P Retail ETF. It's a retail ETF over here. I think it'll provide you a little bit more protection than just going out and buying Target. You're buy Target out there, you're going to be bottom fishing. But there's one thing that I got to point out, it really bothers me. The implied volatility percentiles, this is like ranking implied volatility into itself. And that basically means it's really low. I don't like the fact that the retailers have been selling off and selling off hard into rather low implied volatility. That's scary. Okay. XRT's implied volatility is low. Look at Target. Target's implied volatility is only 22% ranking. Okay. That's extremely low given the fact that Target has legitimately gotten smacked from 78, okay, into the low 60 range and has earnings coming up. Walmart, okay, you're seeing the exact same thing. So there's rather low implied volatility in here. So rather than go out there and just say, hey, Don is going to buy XRT. Now, I'm actually going to show you something you're going to find quite entertaining here. I've been talking a lot lately about pairs trading. We're going to be doing a pairs trading class here at TheoTrade on February 4th. And if you have questions about it, it's just theotrade.com/pairs. Or you could, of course, email us at just support@theotrade.com. Okay. No real big pitch into here, but I want you to recognize some of the best opportunities in this marketplace right now are pairs. Now, this is going to be a little out there if you've never seen it before, but first and foremost, what I'm going to do is I want to compare the XLF. So here's the XLF. We're going to come over here to studies. We're going to go to add study and we're going to go compare with, and we're going to throw a custom symbol in there. The custom symbol I'm going to throw in there is XRT. What does it stand for? Retail. Okay, so I looked at this pair and I'll clarify exactly what we're looking at here again momentarily. We're going to change this from a candle to a line. All right. On the top of your screen, what do you got over here? You got XLF. What do you got down over here? Okay, you got XRT. So I'm looking at going long XRT, okay, and short XLF. Why? Oh, because of the huge divergence over here. Now, I actually do a little bit of my homework. I don't just look at a chart and go, this is big, this is small. Buy what's small, sell what's big. That doesn't work. All right. You actually have to get into the statistics of this. I looked back on a 3-year. I saw some wild divergences over the last 3 years. But this, okay, what I'm actually looking at right now, for the most part, is the measurable distance, okay, of this divergence versus the measurable distance of this divergence. Okay, and you can see just, well, this is a bigger line than this. And all right, how do you actually statistically quantify that? So you can actually come in here and go XLF minus XRT, enter. Okay, now I got to take all the comparisons out, so bear with me for a second. Now we're looking at XLF minus XRT. These are two totally different products, but I've got a setup for this. Okay, and this is something I'm going to be doing in the pairs class. But again, I just stressed to you, this is the kind of trade that can be really advantageous right now. So this is going to be pairs correlation standard deviation. Let me just remove the RSI Laguerre from here. Okay, what you're actually looking at is just a customized, again, anybody can set this up, but it's just a customized chart setup. Okay, number one, we're looking at the pair correlation. What that pair correlation is doing is it's actually measuring, up here, it's actually measuring, are these two products heavily correlated? Okay, are these two products heavily correlated? And there's a lot of times, and this is over the last 1 year, a lot of times over the last year, that these things run almost a 100% correlation. And there's other times they're vastly non-correlated. Okay, so you can actually have something that's heavily correlated, which means it's moving at a rate in tandem of about 100%, or you can get an inverse correlation, which is like -1, which is it's moving the exact opposite, right? But down below, this is a standard deviation. And if you look back over the last year, okay, what standard deviation right here is the average of what this pair runs. Out here is above and beyond, and this is what we'll call, okay, this is +2 deviations. We'll call these sigmas. Over here, again, this line represents +2 deviations. This is -2 deviations. Okay. We're right now, in the last year, the largest deviation that we've seen anytime in the last year. But then we take this and we back it up 3 years. Okay. We are in 3.5 deviation kind of territory. It's what pairs dreams are made of. Okay, and this is what I'm actually going to do in the class. I'm going to execute the trade because this one is ultimately ripe. And again, what's the trade? Short the XLF, long the XRT. Short the XLF, long the XRT. Whether you look on a 3-year time frame, this is the biggest divergence that's been seen. When pairs trading, this is just, I mean, again, almost unheard of how far off the range this happens to be. And this is a pair, okay, that is normally and relatively heavily correlated out here. So again, when you look at this trade, don't let this stuff confuse you too much. You can actually place trades where you're buying, 100 shares, or for instance, selling 100 shares of XLF and buying 100 shares of XRT. However, the whole key to this trade, the XRT is a $45 product. The XLF is a $23 product. What I'm going to be doing is making those two products, okay, equivalent to one another. And moreover, you just trade these with options. You don't ever have to buy one and sell another because you can't do that inside of an IRA account. But I wanted to show a little bit about a pair correlation, not only because it's on my mind and, I'm about to do a class on it, but I'm telling you, opportunities like this seldom exist in markets over there. So remember a couple of things this week. Number one, we're talking about pairs a lot right now. Obviously, we're doing a pairs class on February 4th. Again, if you're interested in it, just check out, it's theotrade.com/pairs. Okay. And that's not pears like the pear that you eat. It's PAIRS. Okay. It's /pairs. So if you do have questions, support at theotrade.com. Moreover, remember, when everybody's building up the FOMC announcement this week, you got to ask them, how come implied volatility is not elevated? Think about it. Thanks, everybody, for joining us here at TheoTrade. I'm Don Kaufman. I will be back all throughout the course of this week and in the TheoTrade chat room for you. Thanks, everybody. Have a great weekend. Bye-bye.